we take the discussion on replacement decisions in financial management. In this tutorial, we discuss situations where an old machine can be replaced with a new machine. An old machine may be ineffective and may be reducing the net book value of the farm because of the inefficiencies associated with it. For that reason, if you have an old machine which is ineffective and which is not efficient in production, it becomes necessary to replace that old machine with a new machine which is more effective. However, for you to make a decision as to replace the old machine with a new machine which is more effective, we should have an analysis so that when you are coming to that conclusion whether to replace or not, you will have done, or rather you will have arrived at that decision in the right way, in a professional managerial way. For you to replace or for you to make that decision as to whether to replace an old machine with a new machine, you have to make or you have to arrive at that decision after making certain computations and certain analysis with respect to the comparison between the old machine with the new machine. We had discussed this concept in the previous lesson as far as the analysis is concerned, because for today my wish is to take a practical example, but in case you missed this class or this lesson, you can still get it in our YouTube. You can get it in our YouTube simply. But let me remind you of what we said, where you are replacing an old machine with a new machine. First, you are supposed to take the cash price of the new asset, how much it cost you, then you plus incremental costs. Incremental costs are also called incidental costs, which includes costs like installation costs, freight charges, import duty, insurance, or any other cost which should be capitalized or which should form part of the cost of that particular asset. So get the cash price of the new asset, you plus any incremental costs or incidental costs. Then what you get is the depreciable cost of the new asset. Cash price of the new asset plus incremental costs, you get the depreciable cost of the new asset, the amount that should be subjected to depreciation. Then after that, once you get depreciable cost of the new asset, you less the market value of the old machine. See that you have two machines here, an old machine that you want to replace with a new machine. So these three steps are the workings for concerning the new machine, and then you are lessing the market value of the old machine. the machine that has been in operation or in existence and it has become ineffective or inefficient. How much can you sell that machine today in the market? You are lessing that value here, and what you get is the net cost. Once you get the net cost, you look at the whether this asset which you are disposing, whether you are disposing it at a gain or at a loss. If it is at a loss, then that loss you'll be multiplying by the tax rate and then you less that particular figure. If what you are getting, if you dispose that particular asset is a gain, then you multiply that particular gain by the tax rate and you plus that amount here. So the workings for that portion is here. That is, if the market value of the whole asset is more than the net book value of that asset, then that is a gain. You multiply that gain by the tax rate and you plus the amount here. If the market value is less than the net book value of that whole asset which is being disposed, then that is a loss or tax saving. You multiply by the tax rate and you less that figure here. Then the next portion constitutes net working capital. We discussed about the working capital adjustments, that is the effect of the acquisition of this new machine on the current assets such as the stock, the debtors, and the creditors. If you purchase a new machine, it may have an effect of increasing the stock or increasing the debtors or decreasing those items, increasing the creditors or decreasing the creditors. So the adjustments for those working capital changes will appear here. Having noted yesterday in our previous discussion that if the changes in working capital occurs in the beginning of the economic life of the asset, then it should form part of the initial cost. However, when calculating the depreciation, we should exclude the net working capital changes. Therefore, in this situation, assuming that when we replaced this machine, the changes in working capital occurred in the first year of the economic life of the asset, then those changes should be entered here to arrive at the initial capital outlay. However, if the changes in working capital occurs by the end of the economic life of the asset, then it should be accounted for under the terminal cash outflow, the terminal cash inflow rather. Also, we noted that all these changes in working capital must be recovered by the end of the economic life of the asset. Up to this point, we have the initial capital outlay. Then after that, we compute the DTS, the depreciable tax shield. So compute incremental depreciation per annum for the new asset, the depreciation basically for the old asset and the new asset. Take the depreciation for the new asset and then you less depreciation for the whole asset. And you get the depreciation, incremental depreciation. So this incremental depreciation, you multiply by the tax rate to get DTS, depreciable tax shield. Then we compute the incremental operating cash flows per annum and the terminal cash flows. Start with the terminal cash flows. Take the salvage value of the new asset. you minus the salvage value of the whole asset, and we get the net salvage value. Once you get the net salvage value, we earn the changes in working capital, or the working capital recovered by the end of the economic life of that asset, and then we have the total cost there. Incremental cash flows will comprise of increase in sales volume. If the purchase of this machine resulted to increase in the sales, then we plus. If costs decreased, you see a decrease in cost or decrease in expenses implies cash in. Then after that, you get the cash flows before tax. So note that format is very critical. We are going to take a question in a while, which will require that format which we have discussed right here. Now, determination of after-tax cash flows. Cash flow is the difference between the cash inflow and the cash outflow. It is determined as follows. Cash flows, you'll be taking the cash inflow minus cash outflows. Then after tax cash flows, the format, even though this one we had discussed previously, the after-tax cash flows, also known as EBDT, the earnings before depreciation and tax. Once you get the earnings before depreciation and tax, you can just multiply the earnings before depreciation and tax by, multiply this figure by 1 minus t plus DTS. DTS is given by depreciation per year times tax rate. So once you have done that, you will have gotten the cash flows, the net operating cash flows. So alternatively, you have total sales or revenue. You minus the total variable cost to get total contribution. Then you also less fixed costs. You get earnings before depreciation and tax. Then you less depreciation. You get profit before tax. When you less tax, you have profit after tax. Then you earn back depreciation. You get after-tax cash flows. Now to arrive at this point here, the last stage, if you have earnings before depreciation, you can just multiply this EBDT by 1 minus tax, then you plus depreciation times tax rate. You will have arrived at this point there. Now that is something that we discussed yesterday, and if you missed that lesson, you can have it. We uploaded that in our YouTube. You can just get it in our YouTube. Now let's take an example here. We take an example here, and the example is here. We are told Telex Limited is contemplating acquisition Telex Limited is contemplating acquisition of a new machine to replace the one currently being used in production process. The existing machine was acquired 2 years ago at a cost of shillings 8 million. The existing machine was estimated to have a useful life of 5 years with no salvage value. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of shillings 1.5 million. The existing machine can be disposed of now at shillings 4 million. The new machine is expected to cost shillings 12.56 million with a salvage value of shillings 4 million at the end of its useful life of 5 years. The new machine will also require an additional investment in working capital of shillings 2.6 million at the start of its useful life, which will, however, be recovered at the end of its useful life. The following information relates to the estimated earnings before depreciation and tax. You can rectify that. That should read: the following information relates to the estimated earnings before depreciation and tax (EBDT) over the coming 5-year period for the two machines. Year 1, 2, 3, 4, 5. So the new machine is generating 5.4 million. That is an annuity. Those cash flows are constant. Those cash flows are constant. 5.4 million for the new machine. That is what the new machine is generating. The existing machine, or the whole machine, from year 1 to year 5, it is generating 3.2, 2.8, 3 million, 2.4 million, and then 2 million. Telex Limited's cost of capital is 13%. The company applies a straight line method of depreciation. The corporate tax rate is 30% required. Using the net present value technique, and advise the management of Telex Limited on whether to replace the existing machine with a new machine. Now, just go through the question once again. You pause your video and you go through that question, understand the question, and then we can check the solution. Now we start with calculating depreciation of the whole machine. Depreciation, we are going to use a straight line method. So cost divided by expected life. You've been told the cost of the whole machine, it cost 8 million, and the expected life was 5 years. So 8 million divided by 5 years, you get 1.6 million. So depreciation per year is 1.6 million, but we have this asset for the last 2 years. Therefore, for the last 2 years, if per year the depreciation is 1.6, then for 2 years the depreciation is 2 times 1.6, which is 3.2. Therefore, the accumulated depreciation is 3,200,000. The net book value will be given by cost minus accumulated depreciation. The cost of that asset was 8 million with less 3.2 million. That is the depreciation for those 2 years. You get 4.8 million. So the net book value for the old machine is 4.8 million. Now this machine, we have been told that it is being sold at 4 million shillings. The salvage value is 4 million shillings. So this machine is being sold at a loss since the market value is less than the net book value. That is, the net book value is 4.8 million, but the salvage value is 4 million. So loss of 8 million. Now we go to the next page, we continue with the discussion. Now once you have gotten that, the next thing now, remember the format which I've just shown you. Now we have we have the cash price of the new machine. The new machine cost 12,560,000. We earned installation cost or incidental costs. There were no incidental costs. There was no incidental cost, so 0. The market value of the old machine, we less. You have been told the old machine can be sold at 400,000 shillings. So 12,560,000, which is the cash price of the new machine, we less the market value of the old machine, and the net cost is 8,560,000. Then tax on the loss. You have said the old machine is being sold at a loss because the net book value for the old machine is 4.8 and the market value is 4. So tax on that loss, that percent of that loss, 240,000 is what you less. Then increase in working capital. You have been told about working capital, which is needed by the start. It's 2.6. 2.6 is required. Now, sum up all that, we get initial capital outlay of 10,920,000. Then terminal cash flows, salvage value of the new machine. The new machine can be sold at 4 million. We less the salvage value of the whole machine. The whole machine can be sold at 1.5. Then the difference now gives us the net salvage value of 2.5. 4 million minus 1.5 is 2.5 million. That is the net salvage value. We earned the working capital recovered. The 2.6 million here should be recovered by the end of the economic life of the machine and should form part of the terminal cash flow. So we earned the working capital recovered and our total terminal cash flow will be 5,100,000. From there, incremental depreciation tax or the DTS. We take DTS on the new machine, that percent of that, and then DTS on the old machine, that percent of that, and then the difference. So depreciable tax shield, we get depreciation. The cost of the new machine was 12,560,000. What you have just calculated is given. 12,560,000 is the cost of the new machine minus the salvage value. The new machine can be disposed of at 4 million divided by 5. The expected life of that machine is 5 years. Then you multiply by that percent, you get 513,600. The DTS on the whole machine. The DTS now, you take the net book value, 4.8, you minus the salvage value, 1.5, divided by expected life of 5 years, you multiply by that percent, we get 198,000. So DTS, you take the DTS for the new machine minus the DTS for the whole machine, we get 315,600. So up to that, this DTS is very important. This total terminal cash flow of 5.1 is also important, and this initial capital outlay is very important. We move on. I believe you have the question from the other side. You must have taken note of that. Now you have seen these cash flows now from the new machine. The new machine is generating constant cash flows. We minus the cash flow. These cash flows are given in the question. In the question, refer back to the question. The new machine was to generate these cash flows for the 5 years, annual cash flows. Then the old machine was to generate these figures. So you take the cash flows to be generated by the new machine, you minus the cash flows by the whole machine, and you get earnings before depreciation and tax, this column. So once you have this figure, To get net operating cash flows, you can multiply each of these by 1 minus T plus DTS. DTS, we have it here, 315,600. We have the DTS here. That's why we are adding back the DTS here. So we have taken 1 minus tax, which is 1 minus 0.3 times these figures. Then what we get, we add DTS and we get net operating cash flows. Now once we have net operating cash flows, these cash flows here, they are the ones that we are going to use to calculate the net present value. Note this point here, incremental net operating cash flow or net operating cash flow is given by earnings before depreciation and tax. You multiply by 1 minus tax plus depreciation times tax rate of that percent, and T is a tax rate. That's 1 minus T is 1 minus 0.3. To advise the company on whether to replace the machine or not, we use the net present value as follows. So note these cash flows which we have here. So we go to the other side. Now our cash flows from the other page, for year 1 up to year 5, we have 18, 55, 600, 21, that 5, 600, 19, 95, 600, 24, 16, 600, 26, 95, 600, and then these are the 5100 because we have the amount to do with the salvage value. This figure there, this figure, we have this figure here, total terminal cash flow, 5,100,000. The total terminal cash flow, it occurs or it occurred in year 5. That's why we have these cash flows here. We got these cash flows, we have calculated these cash flows, and then year 5 you can see we have 5.1, which is to do with the salvage value. Once you have those cash flows that way, the next column is present value interest factor at 13%, which can be calculated by 1 plus r raised to negative n. And you have this column, here. Now, once you have this column, the present value interest factors, you multiply by these cash flows, and you have the present values. The present values here, sum them together, and you get total present value. Then you less the initial capital outlay, which we have it here. We have it here. 10, 9, 20,000 is the initial. Is the initial capital. Then once you have that, the initial capital we less. So the total present value, you less total initial capital of 10, 9, 20. The net present value is negative 507,665. When net present value is a negative, we usually reject the decision, because a negative net present value implies that such a decision will reduce the value of the firm. So you can see what you have said down there, that it is not advisable to replace the machine since such a decision will result to a negative net present value. In year 5, we have two cash flows. the shillings 5.1 million placed to terminal cash flow. So that is what that question required. I just go through it again. So I started by showing you the format. I started by showing the format. Situations where you are replacing an old machine with a new machine. You follow that format. The format is there. You just pause your video and you see the format that you follow. You just observe the format that you should follow. Now once you have followed on that side, then the question started from there. That's where the question started. You read through the question, go through the question, and then the cash flows generated by the new machine and the old machine. The tax rate is that percent. Cost of capital 13%. Solutions are there. The workings are there. You can write those workings somewhere. Then we move to page 29. Page 29, where the solution now begins. The solution begins there. The initial capital outlay, we got 10,920,000. Terminal cash flows, we got 5,100,000. Then DTS, depreciable tax shield, we are taking the cost of the assets minus their salvage value divided by expected life of 5 years times that percent to get DTS. Then incremental cash flows. We have them there. Incremental cash flows. Then lastly, we go to page 30. Page 30. We have it on this side. Page 30. The cash flows is calculated, and in fifth year we have salvage value of 5,100,000. We calculate the present values of these cash flows, and then we less the initial capital of 10,920,000, and the net present value is negative 507,665. Therefore, we should not replace that machine. The reason being, if you replace the machine, it will reduce the value of the farm by 507,000 shillings 665. Okay, that is it. You can just go through it. If you have a question, my numbers are there. I'll give you an assignment, but I'll show you the assignment briefly so that you have an idea. Now we have a question there which says Texas Limited intends to replace a can sealing machine with a new one which the management believes more efficient. The old machine was purchased 3 years ago and has 3 more years of economic life with a salvage value of shillings 850,000 at the end of this useful period. Additional information. The current net book value of the old machine is shillings 2,950,000, while its current market price is shillings 3,700,000. The new machine costs shillings 11 million and has a useful working life of 3 years. It's estimated to have salvage value of shillings 3,500,000. Number 2, purchase of the new machine would result in the following changes. Number A, sales would increase by shillings 1,200,000 per annum. Number B, expenses would decrease by shillings 1,800,000 per annum. Number C, stocks and creditors would increase by shillings 3 million and shillings 1 million respectively in the first year in the new machine's working life. However, in the final year of the machine's usage, stocks and creditors would decrease by shillings 3 million and shillings 1 million respectively. The cost of capital is 12% and the corporate tax rate is 30% required. Advise the management on whether the whole machine should be replaced. Now pause your video and then attempt the question first. You pause your video and you attempt that question first. I'll show you. We had done that question during the daytime classes. Therefore, I can just show you the solution from the other side. I'll show you the solution from the other side. Attempt the question first. Attempt the question first. I'll show you the solution from the other side. Now we have the solution there. On this side, you can start from here. The initial cost will be what are we being told from the question? We'll be told Texas Limited intends to replace a can sealing machine with a new one, which the management believes more efficient. The whole machine was purchased 3 years ago and has 3 more years of economic life with a salvage value of shillings 850,000 at the end of this useful life. Additional information. The current net book value of the whole machine is shillings 2,950,000 while its current market price is 3.7. Then the new machine costs 11 million. So cost of or the cash price of the new machine is 11 million. We have omitted the 3 zeros there. Then installation cost, there is no installation cost, 0. We less the market value of the whole machine. The whole machine can be sold at how much? 3.7. That has been given there. You have been told that the current net book value of the whole machine is 2,950,000 while its current market price is 3.7. So the market value of the whole machine, we less that 700. The net cost is 7,300. Tax on gain on the disposal, the whole machine. When we dispose the whole machine, are we disposing at a loss or a gain? Now, comparing or having been told in additional information, number 1, the current net book value of the whole machine is 2,950,000 while its current market price is 3,700,000. So if the net book value is 2,950,000 but you are selling at 3.7, then this is a gain. It is a gain. So that is why we are saying we earned tax on gain on disposal. The market value is 3,700,000, but the net book value is 2950. So that gain, that percent of that percent of that 700 minus 2950 is 225. Working capital changes. We said that when changes in working capital occur by the start of the economic life of the asset, then they should form part of the initial capital. We've been told that stocks will increase by 3,000. So increase in assets you plus. Creditors will also increase by 1,000. When creditors or liabilities increase, you are supposed to less. So the changes in working capital in that case will be 2 million here. So increase in stock 3,000, increase in creditors 1,000. So working capital changes is 2,000. So our initial capital will be 95.25. 95.25. Sum up the figures downwards. From there, incremental depreciation, that is the DTS. The new machine cost 11. The new machine cost 11 million. We minus the salvage value of that 500 divided by 3, which is the expected life. The whole machine, the net book value was 2950. You minus salvage value of 850 divided by the expected life of 3, which is 700. So the incremental depreciation 1800, 2500 minus 700 is 1800. You multiply by that percent, that gives you 540. So 540 is the DTS, depreciable tax issue. From there, terminal cash flows. We are told the salvage value of the new machine was that 500. We minus the salvage value of the whole machine, which was 850. Then the net salvage value will be 2650. The working capital recovered. These are the working capital recovered by the end of the economic life. We are told that creditors will increase by 1 million, and let me just be specific of that point. Number 2C, stocks and creditors would increase by 3 million and 1 million respectively in the first year in the new machine's working life. So that one is supposed to affect the initial capital outlay, since we said that when changes in working capital occur by the start of the economic life of the asset, then such changes should form part of the initial capital outlay. Okay. However, in the final year of the machine's usage, stocks and creditors would decrease by 3 million and shillings 1 million respectively. So those changes which are occurring by the end of the economic life of the asset, then they should be part of the terminal cash outlay, which are appearing here. The working capital recovered 1,000 minus 3 million, which is 2,000. Then the total cost now, our total cost, you work it out to give you 650. Then finally, the incremental, the last part now will be incremental cash flows. The incremental cash flows. We are told that sales were to increase by 1,200, expenses were to decrease by 1,800. You see, when we are analyzing from this side, if expenses decrease, there is a point which is given concerning that. Number 1, 2A, sales would increase by shillings 1,200,000 per annum. Then B, expenses would decrease by shillings 1,800,000 per annum. So if sales are increasing, that's a plus. Increase in sales 1,200, decrease in expenses 1,800. Then what you get if you sum up the two is the before tax cash flows, or the cash flows before tax, which is 3,000. We less that percent. That percent of 3,000 is 900. So 3,000 minus 900 is 2,100. That is earnings after tax. We earned back DTS, depreciable tax issued. We calculated that here. DTS is 540. DTS 540. We calculated that as DTS. We add back the DTS. Then what you get is the net operating cash flows of 2,640. So it implies that each year for these 3 years, this project is generating a constant cash flow of 24,660. So to calculate the net present value, we take the amount times present value annuity factor. We are using annuity because the implication is that this 2640, this 2640 here is being generated for each year for those 3 years. First year 2640, second year 2640, third year 2640. So you're taking net present value will be given by the annuity times present value annuity factor using 13%, which gives you 2.4018. The present value annuity factor, if you use 13% in 3 years, you get 2.4018 multiplied by the annuity is 2460. We plus 650. This total cost here, the terminal cash flow of 650 is generated once. It's generated once in the third year. So here we are taking the 650 times present value interest factor 13% third year gives you 0.7118. Then you minus the initial capital outlay. We got 9525. 9525 was the initial cost. This is what you are lessing. 9525 is the initial cost. So that is that the net present value now will be negative 2721. The advice we are told, don't replace the machine. Don't replace the machine. So I give you back that question. You can go through the question during your free time. The question is there. The question is there. I read it again for you. Texas Limited intends to replace a can sealing machine with a new one which the management believes more efficient. The whole machine was purchased 3 years ago and has 3 more years of economic life with a salvage value of shillings 850,000 at the end of this useful period. Additional information: the current net book value of the whole machine is shillings 2,950,000, while its current market price is shillings 3,700,000. The new machine costs shillings 11 million and has a useful working life of 3 years. It's estimated to have salvage value of shillings 3,500,000. Number 2, purchase of the new machine would result in the following changes. Number A, sales would increase by shillings 1,200,000 per annum. Number B, expenses would decrease by shillings 1,800,000 per annum. Number C, stocks and creditors would increase by shillings 3 million. and shillings 1 million respectively in the first year in the new machine's working life. However, in the final year of the machine's usage, stocks and creditors would decrease by shillings 3 million and shillings 1 million respectively. The cost of capital is 12% and the corporate tax rate is 3% required, and advise the management on whether the whole machine should be replaced. So that is your question. That is your question. You can attempt that question. Now, once you attempt the question, you can just look at my solution there. You can attempt the question first. My solutions are there. So you start from this side, the initial cost. The analysis is there. You have done the initial cost. Up to the working capital, we got initial cost of 95.25. Then incremental depreciation, which helps us to get DTS, depreciable tax issue, which gave us 540. Then terminal cash flow, we are doing the salvage value for the new machine minus that of the old machine. And after getting the net salvage value, we also consider the working capital recovered. Then total cost, we got total terminal cash flow, gave us 650. Then incremental cash flows, increase in sales, we plus decrease in expenses, we less tax, we get earnings after tax, we earn back DTS, depreciable tax issued, we get net operating cash flows of 2640. Then this 2640 is an annuity because it is constant figure generated for those 3 years. So net present value is given by amount times present value annual factor at 13%, 3 years plus present value interest factor, that is the 650 for 3 years at 13% minus initial cost of 95.25. The net present value is negative 27.21. When the net present value is a negative, we reject the project. But if it is a positive, we accept the project. That is it for today. In case you have a question, my numbers are 0727 871093. My name is Mr. William. My numbers are as well here in our book. I'm also a publisher. And an author. So in case you need books for CPA or for CIFA or for ATD, you can contact me through that number 0727 871093. You can also get online classes or physical classes if you are in Thika town or if you are within Kiambu County. You can still get online classes wherever you are, even if you are in foreign countries. We can still assist you wherever you are through the use of technology. So that is the end of our class today. So next class, we be taking a different concept because I think we have covered the replacement decisions. So let's meet next lesson. Have a good day.